There's something almost mystical about the number 54 that keeps appearing in economic history. Every 54 years, like clockwork, markets collapse, governments panic, fortunes vanish overnight, and if you line up the dates on a calendar, the pattern seems so perfect it feels like the universe itself is running on some hidden timer. 1873, the panic that triggered America's first Great Depression. 56 years later, 1929, the crash that defined an entire generation. Then, 1987, Black Monday, when markets lost 22% in a single day. The math works, the intervals line up, and plenty of people have built entire investment strategies around this so-called cycle, convinced they've discovered nature's secret rhythm for financial destruction. But here's what nobody tells you about the 54-year panic cycle. It's a beautiful theory built on cherry-picked data. When you actually examine every major financial crisis over the past 3 centuries, most of them don't fit the pattern at all. 1857 happened 16 years after the previous panic, not 54. 1907 came only 14 years after 1893. 2008 arrived 21 years after 1987, not 54. The cycle breaks down the moment you stop selecting only the crises that confirm it. And yet the theory persists because it offers something humans desperately crave. The illusion that chaos follows rules, that if we can just find the right pattern, we can predict when disaster strikes and position ourselves accordingly. The 54-year theory comes from the work of David McMinn, an Australian researcher who spent decades analyzing financial panics and discovered what he believed were profound connections to lunar and solar cycles. McMinn documented a 9/56-year grid where financial crises clustered with what he argued was statistical significance. He noticed that panics occurring in the same sequence on his grid often happened at similar times of year, and that these alignments corresponded perfectly with the positions of the lunar ascending node and other celestial mechanics. McMinn wasn't claiming astrology. He was proposing that tidal forces, the same gravitational pulls that move oceans, might influence mass psychology during periods when markets are already fragile. It's an intriguing theory, and McMinn's academic papers showed genuine mathematical rigor in identifying these patterns. But there's a problem with any theory that finds cycles in historical data. You're looking backward, selecting events that fit, and ignoring everything that doesn't. This is called pattern recognition bias, and it's especially powerful when dealing with rare events like financial panics. There haven't been that many true market collapses in modern history. Maybe 20 or 30, depending on how you count them. When you've got a small sample size and you're free to adjust your starting point, your interval length, and which events count as panics versus mere corrections, you can make almost any pattern appear. McMinn's work demonstrates real correlations in certain sequences, but correlation doesn't establish causation, and the theory struggles to explain why so many major crises fall completely outside the predicted windows. Let's walk through the actual timeline of financial panics since 1760 to see where the 54-year cycle holds up and where it collapses. In 1792, the United States experienced its first financial panic when speculative frenzy surrounding Bank of the United States securities crashed in March. 56 years later, in 1848, France had a revolution that triggered financial crisis, but this wasn't primarily a market panic driven by leverage or speculation. It was political upheaval that happened to disrupt finance. The connection is weak. 1857 brought a genuine banking panic in October, triggered by the failure of Ohio Life Insurance and Trust Company. This one spread from the United States to Britain and then across Europe. It was a real systemic crisis. 54 years later would be 1911, but there was no major panic in 1911. The Panic of 1907 happened 4 years earlier, in October of that year. 1873 is one of the anchors of McMinn's theory. The Panic of 1873 began in September when J. Cook and Company, the nation's most prominent banking house, failed spectacularly. This triggered bank runs across New York, Philadelphia, and other financial centers. The stock exchange closed for 10 days. Within months, the crisis spread globally, particularly hitting Vienna, which had already crashed in May of that year. The depression that followed lasted 6 years, the longest economic contraction in American history up to that point. 56 years later brings us to 1929, and here the cycle seems to work. The crash of October 1929, Black Thursday and Black Tuesday, remains the most famous market collapse in history. Stock prices fell 90% over the next 3 years. Banks failed by the thousands. Unemployment reached 25%. The Great Depression reshaped global politics and economics for a generation. But then the pattern breaks again. 54 years after 1929 is 1983, and nothing happened in 1983. Markets were recovering from the early 1980s recession, but there was no panic. The next major crash was October 1987, 58 years after 1929, not 54. Black Monday in 1987 saw the Dow Jones Industrial Average fall 22% in a single day, the largest one-day percentage decline ever recorded. But the crash was contained quickly. The Federal Reserve flooded markets with liquidity. The economy didn't enter recession. Within 2 years, stock prices had recovered completely. 54 years after 1987 would be 2041, which obviously hasn't happened yet. The next major global financial crisis was 2008, only 21 years after 1987. When you lay out every significant panic chronologically, the 54-year cycle captures maybe 4 or 5 events while missing 15 others. 1819, 1837, 1839, 1857, 1873, 1884, 1890, 1893, 1907, the series of panics from 1930 to 1933 during the Great Depression, 1987, 2008. The intervals between these crises range from 2 years to 58 years with no consistent pattern. 1837 followed 1819 by 18 years. 1839 came just 2 years later. 1857 was 18 years after that. 1873 arrived 16 years later. 1893 was 20 years after 1873. 1907 came 14 years later. The numbers are all over the place. So if the 54-year cycle doesn't actually explain most crashes, what does? This is where the theory becomes useful not as prediction, but as misdirection. People spend so much energy trying to count years and align dates with celestial mechanics that they miss what's actually happening in every single crash, regardless of timing. There are 3 factors that appear in every major financial panic across 3 centuries: excessive leverage, liquidity mismatch, and narrative collapse. These 3 elements combine in different proportions and sequences, but they're always present. And unlike mystical cycles, these are observable, measurable conditions that build up over time and eventually trigger catastrophic unwinding. Let's start with leverage because it's the foundation. Leverage means borrowing money to invest, using debt to amplify returns. If you have $10,000 and you invest it in stocks that rise 10%, you make $1,000. But if you borrow $90,000, invest the full $100,000, and stocks rise 10%, you make $10,000 on your original $10,000. That's leverage. The problem is, it works in reverse. If stocks fall 10%, your $100,000 position loses $10,000, wiping out your entire equity. And if you can't meet the margin call, the lender forces you to sell at the worst possible moment, driving prices lower and triggering more margin calls for other investors. This creates a vicious cycle where falling prices force selling, which causes further price declines. Every major panic in history has involved leverage reaching unsustainable levels across large portions of the financial system. In 1873, railroads borrowed massive amounts to finance expansion. When revenues couldn't support the debt service, railroads defaulted, banks holding railroad bonds failed, and the panic spread. In 1929, margin debt, money borrowed to buy stocks, reached 10% of GDP. Investors were buying stocks with only 10% down, borrowing the rest. When prices started falling, margin calls forced liquidation at exactly the wrong time. By 1932, margin debt had been completely wiped out through forced selling and defaults. In 2008, the leverage was in housing. Subprime mortgages allowed people to buy homes with zero down payment. Banks then leveraged those mortgages 30-1 through securitization. When housing prices fell even slightly, the entire capital structure collapsed. The critical insight about leverage is that it builds up slowly during good times and unwinds catastrophically during bad times. When asset prices are rising, leverage seems like genius. Every dollar borrowed returns more than the cost of borrowing. This creates a feedback loop. Rising prices encourage more borrowing. More borrowing drives prices higher. Higher prices make lenders more willing to lend. The cycle continues until something breaks. That something is usually a small shock, something that by itself shouldn't matter much. But in a highly leveraged system, small shocks get amplified. A 5% decline in asset values becomes a 50% loss for someone levered 10-1. That loss forces selling. The selling drives prices lower. Other leveraged investors face the same dynamic. Within days or weeks, the entire system is unwinding simultaneously. The panic of 1907 demonstrates this perfectly. The crisis began with the failure of the United Copper Company in October. F. Augustus Heinze attempted to corner the market in United Copper stock, buying shares with borrowed money to drive the price up. The scheme failed. The stock collapsed. Heinze's banks, which had financed the operation, faced massive losses. Depositors panicked and withdrew funds from any bank associated with Heinze. These bank runs spread to other institutions. The problem wasn't that United Copper was systemically important. The problem was that the banking system was so leveraged that one medium-sized failure triggered cascading panic across New York's financial district. J.P. Morgan personally organized a bailout, gathering bank presidents in his library and forcing them to pledge funds to stabilize failing institutions. It worked, but only temporarily. The crisis revealed how fragile a leveraged system becomes. Liquidity mismatch is the second factor, and it's subtler than leverage, but equally destructive. Liquidity mismatch occurs when an institution borrows short-term money to invest in long-term assets. Banks do this naturally. They take deposits which can be withdrawn on demand and make loans that mature in years or decades. As long as depositors don't all ask for their money back simultaneously, the system works. But during panics, liquidity mismatches become fatal. Depositors demand cash. The bank must sell assets to meet withdrawals, but long-term assets can't be sold quickly without huge losses. The bank either defaults on deposits or sells assets at fire sale prices, taking losses that eliminate capital. Either outcome destroys the institution. The Panic of 1893 illustrates how liquidity mismatch amplifies crises. The panic began when several major railroads defaulted in early 1893. This spooked investors who started withdrawing deposits from banks that held railroad bonds. Banks needed to sell assets to meet withdrawals, but railroad bonds had become illiquid. Nobody wanted to buy them. Banks were forced to sell other securities at depressed prices just to raise cash. This created a liquidity spiral where selling begat more selling. Over 15,000 businesses failed, 500 banks closed, unemployment reached 20%. The underlying cause wasn't that every bank was insolvent. Many banks had plenty of assets to cover liabilities if given time. The problem was timing. They needed cash immediately, and they held illiquid assets that couldn't be converted to cash without catastrophic losses. Long-term capital management in 1998, while not quite a full-scale panic, demonstrates liquidity mismatch in modern form. LTCM was a hedge fund run by Nobel Prize-winning economists and legendary traders. They built massive positions in convergence trades, betting that similar securities with small price differences would converge over time. The trades were sound in theory. They used extreme leverage, 50-1 in some cases, and they funded long-term positions with short-term borrowing. When Russia defaulted on its debt in August 1998, markets froze. LTCM's trades moved against them. Their lenders demanded more collateral. LTCM needed to sell positions to meet margin calls, but the markets they traded were illiquid. Their selling moved prices further against them. Within weeks, LTCM lost $4.6 billion and faced complete collapse. The Federal Reserve organized a bailout because LTCM's failure would have forced liquidation of over $1 trillion in positions, potentially triggering a global financial crisis. The 2008 financial crisis combined leverage and liquidity mismatch on an unprecedented scale. Banks held mortgage-backed securities, long-term assets that were difficult to value and impossible to sell during crisis. They funded these positions with short-term borrowing in the repo market, overnight loans secured by the securities themselves. When housing prices fell and mortgage defaults rose, the value of mortgage-backed securities collapsed. Lenders in the repo market demanded higher collateral or refused to lend at all. Banks faced a choice: sell securities at fire sale prices and realize massive losses, or default on repo borrowing. Either choice led to failure. Bear Stearns collapsed in March 2008. Lehman Brothers failed in September. Merrill Lynch was forced into emergency sale to Bank of America. AIG, the insurance giant, needed a government bailout. The liquidity mismatch meant that even solvent institutions couldn't survive if they couldn't roll over short-term funding. The third factor is narrative collapse, and this is the psychological component that converts leverage and liquidity problems into full-scale panic. Every boom period is sustained by a narrative, a story that explains why this time is different, why traditional valuation metrics don't apply, why prices can only go up. These narratives aren't lies exactly. They're frameworks that people use to make sense of complex systems. During the 1920s, the narrative was that new technologies, radio, automobiles, electrification, had created a permanently higher plateau of prosperity. Stock prices reflected this new reality. Traditional price-to-earnings ratios were obsolete because earnings would grow faster than ever before. The narrative was compelling because it had elements of truth. Technology was transforming the economy, productivity was rising, but the narrative ignored leverage and valuation extremes. During the late 1990s, the narrative was the internet revolution. The world was moving online. Companies that established internet presence would dominate their industries. Profitability didn't matter in the short term because network effects and first-mover advantages would create monopolies that would print money forever. This narrative drove stock prices to absurd levels. Pets.com went public with a market capitalization of nearly $300 million despite losing money on every transaction. The narrative made this seem reasonable. Get big fast, lose money to gain market share. Eventually, scale will bring profitability. When the dot-com bubble burst in 2000 and 2001, the narrative collapsed. Investors realized that most internet companies would never be profitable, that network effects didn't guarantee success, that old-fashioned business fundamentals still mattered. The collapse in belief preceded and amplified the collapse in prices. The 2008 crisis had its own narrative: housing prices never fall nationally. This belief was widespread. Homeowners, lenders, investors, regulators, they all believed it. The reasoning seemed sound. Real estate is local. Some cities might see price declines, but not everywhere simultaneously. Therefore, a national portfolio of mortgages is safe because geographic diversification eliminates risk. This narrative allowed the entire edifice of subprime lending and securitization to exist. If housing prices never fall nationally, then even risky mortgages are safe because borrowers who can't make payments can always refinance or sell. When housing prices began declining in 2006 and 2007, the narrative didn't collapse immediately. People believed it was temporary, regional, contained. But by 2008, the data was undeniable. Housing prices were falling everywhere. The narrative collapsed. Suddenly, securities that had been rated AAA, the safest possible, were recognized as nearly worthless. This shift in beliefs from certainty to panic happened in weeks and amplified the financial damage exponentially. Narrative collapse works through a psychological mechanism called representativeness. People judge probabilities based on how representative something seems rather than actual statistical likelihood. A long series of good outcomes, rising prices, profitable trades, economic growth, becomes representative of a good state. Even when negative signals appear, people dismiss them because they don't fit the representative pattern. The good state is still the most likely state because it's what recent experience shows. But when enough bad news accumulates, when reality can no longer be ignored, beliefs shift radically and suddenly. This isn't gradual updating based on new information. It's a gestalt shift where the entire framework for understanding the world changes in a moment. And when millions of investors experience this shift simultaneously, markets don't correct gradually. They collapse. Research by economists Nicola Gennaioli and Andre Schleifer on diagnostic expectations shows how this process works mechanically. Investors form beliefs by looking at recent data and extrapolating. During booms, every month of positive returns reinforces the belief that returns will continue. This isn't irrational exactly. It's how humans process information in complex environments where we can't calculate true probabilities. We use heuristics, mental shortcuts. The problem is, these heuristics create systematic biases. We overweight recent experience and underweight base rates. We neglect tail risks because rare events haven't happened recently. We become overconfident in our ability to predict the future because predictions based on extrapolation have been correct for years. Then, when the rare event occurs, when the tail risk materializes, we're caught completely unprepared. The narrative collapses. Confidence turns to panic. And this psychological shift amplifies whatever leverage and liquidity problems already exist. The beauty of focusing on these three factors, leverage, liquidity mismatch, and narrative collapse, is they're observable in real time. You don't need to track lunar cycles or count years since the last panic. You can measure leverage in the system by looking at margin debt, corporate debt to GDP, household debt service ratios. You can identify liquidity mismatches by examining bank balance sheets, looking at the maturity structure of assets versus liabilities. You can detect narrative danger by reading financial media, listening to what investors say, watching for phrases like "this time is different" or "new paradigm" or "permanently higher plateau." These warning signs build up over months or years. They don't appear suddenly on a predetermined schedule. The Panic of 1884 provides an interesting case study because it's often cited in the 56-year cycle theory, but doesn't actually fit. The panic occurred in May 1884 when Grant and Ward, a brokerage firm connected to former President Ulysses S. Grant, failed after Ferdinand Ward's massive fraud was discovered. The failure triggered runs on associated banks and a brief stock market panic. But the panic was contained to New York and lasted only a few weeks. It didn't spread nationally. It didn't trigger prolonged depression. Why not? Because leverage in the broader economy wasn't at dangerous levels. Most banks weren't heavily exposed to Grant and Ward. The narrative around general economic health remained intact. One fraud, even a large one connected to a former president, wasn't enough to trigger systemic collapse. The three factors weren't aligned. Compare that to the Panic of 1893, which did become systemic. The panic began with railroad defaults in early 1893. Reading Company, a major railroad, defaulted on its bonds in February. Northern Pacific Railway went into receivership in August. Erie Railroad defaulted in October. But these weren't the first railroad defaults ever. Railroads had been defaulting sporadically throughout the 1880s. What made 1893 different? The level of leverage across the system. By 1893, railroad debt was enormous, and much of it was held by banks and insurance companies using short-term deposits to fund long-term railroad bonds. When the default started, liquidity mismatches became acute. Banks needed to sell assets to meet deposit withdrawals, but railroad bonds were illiquid. The selling drove prices lower, causing more losses, triggering more withdrawals. And the narrative collapsed. Investors who believed railroads were safe, reliable investments backed by hard assets like track and equipment realized that overbuilding meant many railroads would never be profitable. The combination of leverage, liquidity mismatch, and narrative collapse turned what should have been a manageable problem into a 5-year depression. One pattern that does appear consistently, though not on a 54-year cycle, is seasonal timing. Many major panics occur in September, October, or November. This isn't mystical. It's practical. Before the Federal Reserve was created in 1913, the United States operated on a system where currency moved from eastern financial centers to western agricultural regions during harvest season. Farmers needed cash to pay workers and move crops. This seasonal demand for currency strained bank reserves in New York every autumn. If anything else went wrong, if a major firm failed, or if foreign investors withdrew funds, the seasonal strain could trigger panic. The Panic of 1873 hit in September. The Panic of 1893's worst phase was September through November. The Panic of 1907 began in October. The crash of 1929 happened in October. Even after the Federal Reserve eliminated the seasonal currency shortage, October remained a dangerous month for markets, possibly because traders and investors had internalized the historical pattern and became nervous as autumn approached, creating a self-fulfilling dynamic. But this seasonal pattern isn't a cycle that repeats every 54 years. It's an artifact of how financial systems worked in a particular era, and it persists partly through institutional memory and market psychology. The important insight is that panics don't happen randomly, and they don't happen on predetermined schedules. They happen when specific conditions align: excessive leverage making the system fragile, liquidity mismatches creating vulnerability to shocks, and narratives that blind participants to gathering risks. These conditions can develop over 5 years or 20 years. There's no cosmic timer governing when they align. The 2008 financial crisis demonstrates all three factors reaching extremes simultaneously. Leverage in the banking system was over 30-1 at major investment banks. Lehman Brothers had leverage of 31-1 when it failed. For every dollar of capital, Lehman had borrowed $31. This meant a 3% decline in asset values would wipe out all capital. When mortgage-backed securities fell in value, Lehman was insolvent within weeks. The liquidity mismatch was profound. Investment banks funded their positions in the overnight repo market. Every night, they borrowed money using securities as collateral. If lenders refused to lend the next morning, the bank would fail. And the narrative "housing prices never fall nationally" meant nobody recognized how exposed they were. Executives at these banks genuinely believed their mortgage portfolios were safe. Regulators thought the system was sound. As late as July 2008, just 2 months before Lehman collapsed, Federal Reserve Chairman Ben Bernanke testified to Congress that the worst of the crisis was over. The narrative was so strong it blinded even expert observers to reality unfolding in real time. When Lehman failed on September 15, 2008, all three factors amplified the damage simultaneously. The leverage meant that losses were catastrophic for anyone holding similar securities. Lehman's failure revealed that other banks were similarly exposed. The liquidity mismatch meant that when lenders in the repo market panicked and refused to lend against mortgage-backed securities, even solvent banks faced failure, and the narrative collapse was total and immediate. In the span of days, the belief that the crisis was contained, that the financial system was fundamentally sound, that housing exposure was manageable, all of it evaporated. Investors stopped trusting counterparty risk assessments. If Lehman could fail, anyone could fail. Credit markets froze completely. Stock markets crashed globally. Within weeks, the crisis had spread from investment banks to commercial banks, to insurance companies, to the broader economy. Unemployment rose from 5% to 10% within a year. The response to 2008 illustrates another important pattern. Governments and central banks can stop panics by addressing liquidity directly. The Federal Reserve cut interest rates to zero and bought over $3 trillion of bonds and mortgage-backed securities. The Treasury injected capital directly into major banks through TARP. These interventions worked. The panic ended. The financial system stabilized, markets recovered, but the underlying leverage problem wasn't solved. It was transferred. Private debt became public debt. Household and bank balance sheets deleveraged over the following years, but government debt exploded. The federal debt to GDP ratio went from 62% in 2007 to over 100% by 2012. This isn't inherently bad. Government debt is different from private debt in important ways. Governments can print money, roll over debt indefinitely, and handle much higher debt loads than private actors. But it does mean the leverage is still in the system, just in different form. This creates the setup for future instability because each crisis response uses tools that become less effective the next time. In 1907, J.P. Morgan could gather private bankers and orchestrate a bailout using their own capital. After 1907, it became clear that private solutions weren't sufficient for modern financial crises. This led to creation of the Federal Reserve in 1913, giving the country a lender of last resort with the power to create money in emergencies. But the Federal Reserve existed during the 1930 to 1933 banking panics and failed to prevent catastrophe. The lesson from the Great Depression was that deposit insurance was needed to prevent bank runs. The FDIC was created in 1933. This helped stabilize banking for decades. But in 2008, the crisis came from investment banks and shadow banking that weren't covered by deposit insurance. The solution was massive Federal Reserve intervention through unconventional monetary policy, quantitative easing. That worked, but it left the Federal Reserve's balance sheet loaded with trillions in securities and interest rates at zero for nearly a decade. The pattern is that each crisis reveals new vulnerabilities, prompts new interventions, and leaves the system changed in ways that create different vulnerabilities for the next crisis. This is why 54-year cycles are misleading. They imply that markets operate on some natural rhythm independent of policy and institutional structure. But the actual history shows that financial systems are constantly evolving. The banking system of 1873 was completely different from the banking system of 1929, which was different from 2008. Each operated under different rules, had different types of leverage, faced different regulatory constraints. The common elements aren't cyclical, they're structural. Leverage creates fragility. Liquidity mismatches create vulnerability to shocks. Narratives create blind spots that prevent recognition of gathering risks. Looking at current conditions in late 2025, we can assess these three factors without any reference to cycles or predictions. Leverage exists across multiple sectors. Corporate debt to GDP is at record levels. Many companies borrowed heavily during the low interest rate environment of the 2010s and early 2020s. Commercial real estate is particularly concerning. Office buildings and retail properties face structural challenges from remote work and online shopping. Many of these properties are financed with mortgages that are maturing and need to be refinanced at higher interest rates. Some properties cannot support the debt service at current rates. Regional banks hold significant commercial real estate exposure. This creates potential for leverage-driven problems if defaults begin to cascade. Liquidity mismatches exist in less obvious forms than traditional bank runs. Money market funds, treasury markets, and various corners of the financial system operate with very thin liquidity buffers. The repo market, where trillions of dollars in short-term funding changes hands daily, periodically experiences stress when participants become nervous about counterparty risk. In September 2019, before the pandemic, the repo market suddenly spiked with overnight rates reaching 10%, forcing the Federal Reserve to intervene. These episodes suggest that beneath the surface, calm, liquidity structures remain fragile. Assets that seem liquid during normal times can become illiquid during stress, and institutions that appear solvent with time to work through problems can fail if they need cash immediately. As for narratives, several potentially dangerous stories circulate in financial markets currently. One narrative suggests that artificial intelligence will revolutionize productivity so dramatically that current valuations for technology companies are justified, despite limited proven profitability from AI itself. This sounds similar to internet revolution narratives from the late 1990s. Another narrative holds that federal government debt doesn't matter because the government can always refinance and central banks will support bond markets. This might be true to a point, but there are limits, and when those limits appear, they appear suddenly. A third narrative suggests that the Federal Reserve and other central banks have learned enough from past crises that major downturns can always be prevented through monetary and fiscal intervention. 2008 seemed to prove this. The COVID pandemic response in 2020 reinforced it, But each intervention reduces the ammunition available for the next crisis. Interest rates can't go much lower. Federal debt is already very high. Central bank balance sheets are enormous. What happens when the next shock arrives and the standard tools have already been exhausted? These observations aren't predictions. The three factors exist, but that doesn't mean a crisis is imminent. Leverage can remain high for years. Liquidity mismatches can persist without triggering panics. Narratives can stay intact through many challenges. The 54-year cycle theory fails because it tries to impose mechanical timing on processes that are fundamentally about human behavior and institutional structure. Markets don't crash because 54 years have passed. They crash when leverage reaches unsustainable levels, when liquidity structures can't handle normal fluctuations in confidence, and when narratives that justified rising prices collapse under the weight of contrary evidence. The practical value in understanding these three factors is they provide something actionable. If you watch leverage metrics, you can see vulnerability building. Margin debt as a percentage of GDP, corporate debt service ratios, household debt levels, these measurements tell you how fragile the system is becoming. If you pay attention to liquidity structures, you can identify which institutions or markets are vulnerable to funding shocks. And if you listen carefully to narratives, to the stories investors tell themselves about why valuations make sense, you can recognize when belief systems are becoming divorced from reality. None of this tells you when the crisis will hit, but it tells you whether the system is positioned to withstand shocks or positioned to amplify them catastrophically. The crashes that have occurred, regardless of their timing, all share this signature. The system was fragile due to leverage. The structure was vulnerable due to liquidity mismatches, and participants were blind to the danger due to compelling narratives. In 1873, the narrative was that railroads were the future of transportation and infrastructure investment couldn't fail. In 1929, the narrative was permanent prosperity driven by technology and productivity gains. In 2008, the narrative was that housing prices provided safe collateral and geographic diversification eliminated risk. Each narrative had truth in it, which made it compelling, but each narrative also obscured the specific ways that leverage and liquidity were creating systemic fragility. The 54-year panic cycle is appealing because it offers certainty. If markets crash every 54 years, you can position yourself accordingly, selling stocks in year 53, buying back in year 55, and avoiding the disaster in between. But this mechanical approach misses what actually drives financial history. Markets are not deterministic systems operating on cosmic schedules. They're complex adaptive systems where human behavior, institutional structures, technological changes, and policy responses interact in ways that create emergent phenomena. Sometimes these interactions produce stability. Sometimes they produce instability. The timing depends on how the specific factors align, not on counting years. The lesson isn't to ignore cycles entirely. Long-wave economic theories like Kondratiev waves, which propose 40 to 60-year cycles in economic activity tied to major technological and infrastructural investments, contain insights about how economies evolve. But these aren't rigid schedules. They're observations about how certain economic processes tend to unfold over generational timeframes. Technologies develop, get widely adopted, reach saturation, and then get replaced by new technologies. This process takes decades. Infrastructure investments have long, useful lives and only get replaced when they become obsolete or when major economic expansion demands new capacity. These rhythms create wave-like patterns in economic statistics, but the wavelength varies depending on technological development rates, policy choices, and countless other factors. Similarly, generational patterns in risk tolerance and financial behavior create long-arc dynamics in markets. The generation that lived through the Great Depression remained financially conservative for life, avoiding stocks and keeping money in cash and bonds. Their children and grandchildren who didn't experience depression trauma took more risks and drove the great bull market of the 1980s and 1990s. This generational shift in risk preference affects market behavior over decades. But again, It's not a fixed cycle. It's an emergent property of how human memory and cultural transmission work. People who experience catastrophe become cautious. People who grow up during prosperity become adventurous. When enough adventurous people control enough capital while cautious people have aged out of decision-making roles, conditions become ripe for excess. But the timing depends on demographic structure, which varies across countries and eras. So where does this leave us regarding the 54-year panic cycle and market timing more generally? The honest answer is that precision timing of market crashes is impossible, but recognition of dangerous conditions is achievable. The three factors, leverage, liquidity mismatch, and narrative capture, don't predict crash timing, but they indicate systemic fragility. A system with moderate leverage can handle shocks. A system with extreme leverage amplifies shocks into catastrophes. A system with healthy liquidity buffers can weather temporary funding disruptions. A system dependent on continuous rollover of short-term funding fails when confidence wavers. A system where participants recognize risks in value assets accordingly adjusts gradually to new information. A system where narratives have convinced everyone that risks are minimal experiences, wrenching discontinuities when reality intrudes. Historical analysis of past panics is valuable, not for finding cycle patterns, but for understanding the mechanism through which fragility converts to crisis. The Panic of 1907's progression from United Copper failure to system-wide crisis in October shows how leverage and liquidity mismatches propagate shocks. The crash of 1929's multi-year unwinding demonstrates how debt deflation, where falling asset prices make debt burdens heavier in real terms, creates feedback loops that persist for years. The 2008 crisis's spread from housing to broader economy illustrates how interconnected modern financial systems mean that seemingly isolated problems can cascade globally within weeks. These lessons help identify current vulnerabilities, but they don't provide countdown timers. The mythology of the 54-year cycle persists, partly because it's unfalsifiable for people who want to believe it. When 1983 passed without a crash, adherents adjusted their theory to 58 years or noted that 1987 was close enough. When 2008 happened 21 years after 1987 rather than 54, the explanation became that the cycle had shortened or that multiple overlapping cycles were at work. This kind of after-the-fact rationalization can make any pattern seem valid. The scientific approach is to make specific predictions beforehand and then honestly assess them afterward. McMinn's work does attempt this, predicting crisis windows based on lunar positions and then checking whether panics occurred in those windows. His findings show above-random clustering in certain sequences, which is genuinely interesting. But above random doesn't mean deterministic, and the large number of panics that fall outside the predicted windows limits practical utility for timing decisions. Ultimately, the most robust approach to navigating financial markets isn't trying to time crashes through cycle theories, but building portfolios and strategies that can survive crashes whenever they occur. This means avoiding excessive leverage yourself even when markets reward it. It means maintaining liquidity buffers even when cash yields less than other assets. It means questioning prevailing narratives, especially when they're most widely believed and seem most compelling. The investors who survived and profited from past panics generally weren't those who predicted exact timing. They were those who recognized that valuations were extreme, that leverage was dangerous, that liquidity structures were fragile, and who positioned accordingly despite potentially leaving money on the table during the final manic phase of booms. If history teaches anything about financial crashes, it's that they happen when conditions are ripe for them, not when calendars say they should. The ripeness comes from leverage, allowing small shocks to become large losses, from liquidity mismatches converting temporary funding problems into permanent failures, and from narratives that blind participants to accumulating risks. These factors can align quickly over a few years or slowly over decades. They can exist in one sector or across the entire economy, and they can be triggered by events as varied as railroad defaults, copper market manipulation, housing price declines, or pandemic-induced economic shutdowns. The triggering event almost never seems sufficient in retrospect to explain the magnitude of the crisis that follows. That's because the triggering event doesn't cause the crisis. It reveals the fragility that was already present, built up through years of accumulating leverage, tightening liquidity structures, and strengthening narratives that explained away warning signs. The next major financial crisis will happen when these three factors align again, creating a system vulnerable to shocks and populated by participants who don't recognize the vulnerability. It might happen in 2026 or 2027 if current imbalances in commercial real estate and regional banking trigger broader contagion. It might happen in the 2030s if sovereign debt dynamics finally reach limits that bond markets won't tolerate. It might not happen for decades if policy manages to engineer a gradual deleveraging without triggering cascade failures. The timing is uncertain, but the mechanism is not. Leverage creates fragility. Liquidity mismatch creates vulnerability. Narrative belief creates blindness. These are the constants across every crash in recorded financial history. Watching for these factors provides more useful guidance than counting years or tracking celestial positions, because these factors tell you about the actual state of the system rather than hoping patterns from the past will mechanically repeat in the future. If you found this analysis valuable, if you understand now that market crashes follow human patterns rather than cosmic schedules, if you see that leverage, liquidity, and narrative are the real factors to watch, then you're beginning to read financial history the way it actually unfolds rather than the way mystical cycle theories wish it would. Subscribe if you want to understand how economic systems actually break, because the next crash won't announce itself with a countdown clock. It'll announce itself with rising leverage, tightening liquidity, and increasingly confident narratives, explaining why this time really is different and why traditional risk measures no longer apply. Those are the signals that matter. Those are the warnings worth heeding, and they appear in the data and the discourse, not in the calendar or the